Hello, welcome back. Hope you're having a nice weekend. I'm making a video to talk a little bit about the current status of the stock market and to address some concerns that people may have about a potential crash. Talk a little bit about it. I actually was asked to make a video and decide what are the potential outcomes, what's potentially going to happen, what are the concerns, and what we should be doing as investors, and especially as careful investors. Now, I wanted to point out and start with something in this video, and that is talk a little bit about Cisco. And Cisco Systems was a company that, as you see here, back in 1990 or so, the value of the stock was basically zero, near zero. And then it had an amazing run when it reached, like $81. Now, after the crash happened, the stock went down massively and never recovered. You'll see here that since 2000, like 22 years later, the stock price is actually even less than what it was back in 2000. And the reason for that is that this company was massively overvalued, as you can understand. And so just by showing you this, I wanted to give you an example, a potential example of today. We're looking at Tesla here, which is another company of today that shows the same or similar outcome here. Now, we don't know if Tesla actually will go down that much at any point, but what we do know is that it is overvalued, and we have made all sorts of videos discussing that, and you can see it on the PE. You can actually examine the discounted cash flow model that we have made in previous videos. But we are talking about essentially a very, very overvalued company based on the financials. Now, again, that doesn't mean that Tesla will do the same thing as Cisco, but the point here is that when we're investing, we want to be investing in companies that have a promise, of course, but are not overvalued as well. Because if we buy overvalued instruments, overvalued stocks, for example, at some point when there's a downturn in the economy, this can really, really hurt us. These are going to be the first companies that will crash to the ground. And it will be difficult to recover because they won't have the fundamentals. And so when the trend changes, when they stop becoming the big thing of today, then we're in for a surprise. They may never recover, or they may recover after 20, 30 years. This has happened many times in the stock market. The same thing does not apply with companies like, for example, Facebook here. Let me take a look at this one. Actually, it's FB. Why? This is different with Facebook, for instance, because the PE of Facebook is very low. And so even though it has been going high, and it has had a little bit of a loss now, even though it has been going high, the fundamentals of the company, the financials of the company account for that growth. It's not like it's going high and they have like a 200 PE, 300 PE, and they are not making enough free cash flow to sustain this kind of growth. They can sustain this kind of growth, and they are sustaining this kind of growth. And this is why it is a good investment in comparison to Tesla, which is an overvalued one. Again, I love both companies. I actually love Teslas, but I don't love the stock price. And as we're entering, and when we're actually going to enter, it will happen at some point, a recession phase in the economy, then we may be looking at stocks again going down massively. And if I'm holding Facebook here, even though if it goes down a lot, I still have faith that it will come back up. And it's not about actual faith, it's about reality. Because the company is making money, it can support this kind of continuous growth and going back to its previous levels. Because at its previous levels, it's about fairly priced. While Tesla at its previous levels is massively overvalued, so it may never reach that point. So the next thing that I wanted to talk about is what's going on when there is a crash and how we should be behaving. What should we be doing right now? Should we be avoiding investing? Should we be selling our investments? What should we do? And the first thing that I wanted to examine here is talk a little bit about the time in the market. And you will see here that since 1980, the S&P 500 index has dropped at least 18% 7 times. I've actually witnessed quite a few times that the market has dropped about 10 to 15% myself since I've been invested for more than a decade now. And you will see here that yet over that period of these years, like 40 years, 42 years, someone buying and holding realized the 4,220% gain. And of course, there is an insane volatility, but 10,000 still turned to 432,000 while waiting, while doing nothing really. And of course, yes, there are drops and massive drops that can be scary, but the point here is that these kinds of drops are not sell opportunities, but buy opportunities. And there is an article that I think is extremely, extremely interesting here. Does market timing work? This was a very, very nice article from Charles Schwab. And this is actually a broker that I use. It's a great company, great bank and broker. So 5 investing styles here. Let me break it down for you. Peter Perfect, and I'm not gonna read the whole thing because there's no point. I will just explain the summary of it. Peter Perfect is basically a perfect market timer. He invests $2,000 at the bottoms. That's what it says here. So at the lowest closing point of every year. Well, that's what he does. Ashley here is just investing $2,000 on the first trading day of the year, so January 1st or so. Matthew monthly divides his annual 2000 into 12 equal portions and invests at the beginning of each month. This is basically called dollar cost averaging. So he doesn't really care about the price. He just invests every month a specific amount of money, like $200 here. Rosie here has the worst timing of all. She just invests at the worst time, at the market peaks. And then the market goes down, and yes, she keeps doing that for pretty much every year. And Larry here just leaves his money in cash investments, doesn't invest at all. So you would expect Mr. Perfect here to make the most money, and you would be right. He will be making the most money because he's timing the market perfectly. But it's very, very doubtful that if you can do it yourself, more than likely not. But let's take a look at the very, very interesting chart here and see how they are doing, how these people are doing. And so you'll see that the perfect timing, of course, beats everybody, but you would expect it to beat by a long margin, and that's not the case. Yes, it does beat the person who invests at the very first day of the trading year, but it doesn't beat it tremendously. And also, this person had incredible luck here. They were able to invest in at the bottoms. So, you will not always be able to do that because you don't know when a bottom is. You could be investing now, and then there's a 5% more loss. You just don't know when a bottom is going to be. And so the invest immediately and the dollar cost averaging is basically the same thing. And this is why I'm talking about dollar cost averaging, or just investing money all the time in the stock market as much as you can, because it doesn't really make a difference. Because if you average every month, or you are just investing immediately, this is going to average itself out. Now, the bad timing, still, you would expect somebody who had the worst timing of all these people, like investing at the peaks, to be making much, much less money here, right? Maybe over here or so. But no, they're still making pretty good money and are kind of close to this as well. And of course, the person who stayed in cash has had the worst fate here, as you can see. So inertia is the worst thing, the thing that you want to avoid, not using your money to make more money, of course. And this is very, very interesting because it points to the fact that the more you invest, the more you make over the years, as long as you are disciplined and you are not just selling your investments at the first opportunity just because the market is down. Now, what I do myself and what I definitely recommend people doing is invest in in great companies that have great financials when the market is down, and just forget about the news. This is what I did myself back in 2020, for example, when I remember there was the pandemic thing and everybody was heading for the exits. This is when I bought a lot of stock, actually. For instance, I bought X, which is a US Steel, a circular investment, and I bought it for like $8. It's like 35 now. I sold out of it because, again, it works as a cyclical industry, and at some point it will reverse and go down. Now, I don't know if that will happen now, but I don't want to hold it when it's going up. I want to hold it when it's down. And so other things. I bought Facebook when it was like $150 almost dollars back then. And the reason I did that is because every stock was going down back then, and there was the Cambridge Analytica issue also for plaguing Facebook. But the financials of the company were amazing. And so as the stock market was going down, I was getting a discount on a fantastic company. And I have no fear when it is about buying companies that are doing well. And my recent investment has been on Alibaba, in which I bought a lot of, and I was buying as it was going down and down and down and down, because again, I don't care what the price of the stock is. I care about what the company is doing financially. That's the only thing. And I will never be selling a company just because it goes down, just because its stock price goes down. I would be selling it if the financials of the company, if the actual fundamentals change a lot. Now, you may be wondering, okay, if there is a stock market crash, then how do we feel about it? What do we do? Isn't that an opportunity to sell? And the thing is, no, the actual thing is that this is an opportunity to buy when the stock market is going down, even if there is a crash. And what you should be doing there is slowly accumulate as it goes down and down and down. Keep accumulating and keep the stocks that you have, and just don't succumb to the fear that you are gonna be hearing from all sorts of angles, because everybody's gonna be talking about the down market and insane crash, and smart people tend to accumulate them. And this is why it's always nice to have a little bit of cash and wait for a potential crash on the sidelines, yet still have some investments as well, because you don't know if that will happen tomorrow or in 15 years from now. You just don't know. Now, the current environment is a little bit weird, because we do have the actual increase in interest rates, which is going to keep happening because we have a lot of inflation. We have high inflation. And of course, there is the whole thing with the very, very unfortunate war. But wars are not catalysts that will keep the market down for a long time, unless they are like world wars. So I don't expect this kind of downturn to continue because of the war, but it could continue because of inflation, because inflation is a really, really big driver when it comes to the stock market. And so as it increases and as interest rates increase, then the economy kind of goes down a little bit, it freezes a little bit, because the cost of money becomes higher, so people don't invest that much, they don't buy stuff, they don't want to be getting debt. And so it kind of helps bring inflation down, and this is why the Fed will be doing that. And so in this kind of market, it potentially pays to have some real estate investments that yield income to you, that can be kind of leveraged based on what the interest rates are. Like, for instance, rentals can be nice to hold, or companies that are selling essentials like food and things of that sort. Walmart, for instance, McDonald's, Starbucks, these kinds of companies are great. But in terms of what will happen, we don't necessarily know. What we do know is that the Fed will keep increasing interest rates, because they will have to. There's no way around that. So they will have to do that. And typically, it's better to do it in an abrupt manner. So just keep on doing it and endure a little bit of pain in the stock market. So I do expect that there may be some potential pain, some potential downside for the short run. And this is why I'm having some cash and actually thinking of investing if the stock market goes down. Yet, as I explained earlier, when I saw the opportunity, like Alibaba, I immediately jumped into it regardless of market condition, because I'm seeing a company that is doing fantastically well, and so I don't really care about the market conditions, because I know that they will be temporary regardless of what's happening. And typically, even if there is a big crash in the markets, it tends to last like 2 years, maybe at the most. Like 3, I think, is the worst run ever. And so I'm not really concerned, since the money that I'm invested that I'm invested with, I don't need them. So they will be there and just waiting for the next run. So this is why it's important to invest money that you don't really need. So hopefully that gives you an idea, and I think this one kind of shows you how to react and how to act in regards to investing. I really feel that staying invested really, really helps over the long run. And trying to get the amazing crash, it's gonna be tough to achieve. And if you have some cash on hand, you can still gain some money out of a potential crash of that sort. So yeah, just keep a little bit of cash, wait for it, especially right now when the interest rates are higher, and be ready to buy more if the stock market goes down like 20% or something. So I mean, why not? Why not buy more then? So hopefully that gives you an idea of what we are expecting with the markets right now and what are the potential dangers. And I bring it down to pretty much inflation being the most important thing right now, because it is. And just stay invested, and don't be overly cautious and try to time the market all the time and sell and buy and sell and buy. Just buy when things are low and sell when your investments are overpriced, or you have made a lot of money with those and you are willing to get some of the market. That's it. So hope you enjoyed the video. If you did, leave a like and subscribe if you're not a subscriber already. And I'll see you very soon, probably next week, next Monday, where we're going to be talking about more investments. Or maybe I'll make another video, who knows, we'll see. So thank you for watching, and I'll see you soon. Bye-bye.